Hi, everyone. Welcome to the Capital Raisers Show. I'm your new host, Weston Walker. Today I have Salvatore Buscemi. He is the co founder of Brahmin Partners. He helps elite investors protect and grow their wealth. He also wrote a book called Investing Legacy: How the 0.001% Invest. He has successfully managed money for almost 25 years. Sal, welcome to the show.
Thank you, Weston. It's a pleasure and a privilege. How are you today?
I'm great. So, yeah, let's get into your background, how you got into the position you are today, and the types of people you help.
Yeah, we don't work really with smaller investors that much. I know that's something that a lot of people in the industry sort of gravitate towards, but because of the assets that we get into, they're mostly Class A. We work with different investors. And to get to that point, I started my career out working at Goldman Sachs after college, and it took a lot of work to get there. I write about it in my book, and really it was that I was pre-med. I was thinking that I wanted to go into medical school, and I didn't because I passed out holding a fibula in the cadaver room at the Beth Israel Hospital on Manhattan's Upper East Side that has long been converted to condos. After that, I had sort of like I wouldn't say a breakdown, but sort of like I had a crisis of confidence wondering what I was going to do next because going to medical school was going to be expensive. I didn't want to do it. It wasn't in my soul. Does that make sense? It wasn't in my soul to do it. And the person I was talking to, the surgeon that I was working with, and I gave him absolutely all the best work I could do because he was championing me from medical school, said, Sal, I get it. He helped me with the smelling salt after I passed out holding the fibula. And he said, my brother just made partner at Goldman Sachs. He wants to talk to you. And to me, that was, sort of the next step in the career. And I've always had a deep appreciation for finance. I remember my parents put my brother and myself through private colleges in the Northeast by saving municipal bond coupon payments, 0% municipal bond payments. And these were, basically bonds that were secured by the Water Authority of New York State, the Sewage Authority of New York State. So they were seen as being kind of safe. And with that, I would always go to the bank and clip coupons with my dad and mail them out, and then we get the check back and deposit it into the college account. So it worked out really well. Um, was at Goldman at the age of 25. I lost my father, and I made a promise to myself that I would start my own balance sheet, or become entrepreneurial, if you will, in this business by starting my own fund before the age of 30. And at 29, I raised $30 million from a Park Avenue investment manager, and this is during the time where we had the great financial crisis, and we were basically buying the kitchen sink from Bear Stearns. After that, we had another institutional fund where I lived out west, and that was focused on buying hard money funds that were in receivership, bankruptcy, or some sort of not necessarily nefarious, but there's like a lot of problems that happen with these funds. They over leverage themselves, and so we were buying these assets for literally like 10 cents on the dollar, repackage them, and then send them back out to REITs and other public buyers. We've had a tremendous amount of success doing that, but then what happened in 2014? I started getting outbid. And a lot of the families that I was managing money for in real estate said, why don't you turn your guns on me? Why don't you work with us and raise capital using your real estate investors to invest into our life sciences deals? And that's where I met my partner today, putting together a lot of these deals. And we've had a successful track record in venture, doing a lot of opportunistic type of investing. And we have rules that we abide by with that. Since then, we've done one real estate transaction, which is Class A industrial. We look forward to doing that more so before the end of the year. We have a few deals lined up for that because that's what our investors like. They are already wealthy. They're not looking to get rich. They're not looking to take chances. They're not looking for a lot of good things to happen, sort of like in a rehabilitation or value-added multifamily class D, C to B or something like that. I think right now people, these families, they have operating companies that throw off a tremendous amount of cash flow, and they want to put it into places meaningfully where it can be a store of wealth. And we can go over how we allocate and what the rules are, of course, Weston.
Yeah, of course. And you invest in real estate over all these years. Are there
Yeah.
any other investments that you do currently?
Yeah, I mean, as I said before, we're doing a lot of venture deals. So we started going into life sciences. My partner managed $6 billion for the Rockefeller family office in life sciences at the age of 26. And so the deal flow we get from the networks from being there is really second to none. And we've had some exits investing in fintech companies such as Sing Life. We've invested into companies such as SpaceX, Stripe. We'll be going into a robotics company soon, Neuralink, and some other companies in AI, which you might recognize from the Olympics, one of which is called AI Scout.
Yeah, and so in regards to all these different opportunities that your investors like to invest in, and they see
Hmm.
you as the expert, why should they go with you over anyone else?
I mean, that's a very, very good question. What it comes down to at the end of the day is it's the relationships that you have with these people. These are people who are real estate guys who trusted me over the years because I was a good Boy Scout, putting them into what they saw at the time very far-fetched venture deals. But now they've gotten paid on one of them, so it's not that far-fetched. And also, there's a lot of even if I didn't have a career starting out at Goldman Sachs or anything, I'm always on top, and there's always an interactivity and relationship building with these investments with these investors. Does that make sense? Now, you have to also put constraints on that too, meaning what's so special about us and Brahmin and what we do? Well, as it relates to real estate, we are just equity allocators, all right? And so when we invest into real estate deals, we're not doing the fix and flips ourselves. We're not dealing with general contractors. We're not knocking tin. Does that make sense? So we have three rules that we abide by. Number one, no first-time GPs. I want a GP that's had at least two down cycles underneath their belt. 2008 was one. I want them going back to the late 90s. Number two, I want to see audited financials. And number three, I want to see I want to see that they're putting in a meaningful co-invest. 5% is cute, 10% is thoughtful, anything more shows conviction. In one of the deals that we did, the family office put in 50%, we put in 50%, and it has a 27% IRR. And the families like that, the people trust us because they know that we have rules that we abide by, that we're not just going to be putting money into things that don't follow those three steps. And at that point, then everything else just becomes a story, right? It could be a value-added deal. It could be a Class A office building that's bought at a discount. As long as that checks off and you're working with pedigreed sponsors and GPs, then everything works. And we do the same thing with venture, where it's even more competitive, right? And we say, look, we're not Shark Tank. We're not investing into anything where we're not investing in first-time founders, right? That's not what we do. We've been there before. You get burned. Number two is we want to make sure that there's other family offices that are leading the investment, which is important. Smart money always follows other smart money. And that's usually in the clandestine group of family offices. We like that because they're much more patient investors than, say, institutions that might have like a different agenda where they want to get out of the investment sooner and might push the founder to do something that they really don't want to do too soon.
Mm-hmm. Yeah, besides those three and then going into the story of the investment, is there any other criteria that you look for?
No, that's really it. I mean, right now. I mean, we're sort of agnostic to the asset class. It has to be. We don't want to get into multifamily. A lot of our families lost their shirts after the pandemic because of changes in laws in New York City and other blue states. So they're sort of allergic to multifamily right now. There's also a lot of inflationary pressures. So you're seeing Dollar General and Big Lots are facing bankruptcy. So, we're not bullish on that at all, to use CNBC speak. But, we are looking at things in industrial, cold storage. We like data centers. We like things like that. We don't like things where our tenants are poorer than we are. And that's what our investors expect from us.
Yeah, I just want to be more conservative. So let's go into capital raising for a bit. You wrote
Hmm.
an entire book on capital raising for real estate, and we have a lot of real estate operators and executives that listen to this show. So
Great.
what are your strategies for raising capital? I mean, you do all kinds of different asset classes. What's the commonality between, your top strategies for raising capital between everything that you do?
So here's a story, right? First of all, I wrote a whole booklet that you can get for free on this by going to callingthecapital.com. It's a 27-page handbook of case studies that I've used over the years to raise capital quickly without sounding cheesy, salesy, or slimy. Does that make sense?
Yeah, and we'll link that
Okay.
in the description.
Yeah, please do. Yes, callingthecapital.com. Uh, what you have to do is you need to elevate the status of your investor. Okay, the investor is not going to believe numbers. I think after the 2020 election and with all the polls and everything, people are inundated with numbers. They don't trust numbers. They don't remember numbers, but they remember stories and they remember how they feel. Correct? So, 2 years ago in August, I was in the Northeast, Eastern Long Island, and I was sweating it out. And I received a phone call from someone that said that we had the opportunity to invest into a company, an AI company, for $1 million because the other investor of the family had dropped out or they just ghosted or whatever. We were alongside one of the largest families ever in this space called Raptor. And if you're familiar with it, they were also invested into FanDuel, Fanatics, and other high-profile companies like that that cater to the sports industry. So they made a huge investment into this company called AI Scout. At the time, if you remember, Todd Bowie had just recently bought, for the football fans out there, had just bought Chelsea Football Club. And he bought it from the oligarch Abramovich, who was being forced to sell it and divest of his assets because of what was going on or soon to be happening in Ukraine. Fast forward later, I called him. I said, "Look, it's August. I'm never going to be able to get a guy like Weston Walker on the phone. He's over in the French Riviera. He's in Capri. He's not hanging around. Why am I going to get his attention?" And I finally came up with an idea that was probably the most critical idea, and I'll tell you how we apply it to real estate. I asked him if he could ask the CEO. I asked the CEO if he could get autographed jerseys for every investor that I brought in, signed by the entire Chelsea football team. And sure enough, he did. And that, just doing that and talking about that, people moved to invest into that very, very quickly because I was selling them status. They were going to get a signed jersey that they were going to put in some sort of a glass frame, and they're, in somewhere in Southern California or Salt Lake City or St. George, Utah, where it was actually expanding upon their status. And real estate investors can do this well. Maybe what you can do is award to them. What I like to do is, have closing dinners. I like to go to Fogo de Chao afterwards. I like to talk to people there after the closing. The other thing I like to do too is to give them a gift, and I think something to commemorate that. What that means is maybe giving them like a framed blueprint or something of the investment that you're investing into, or something like that. One of the crazy situations that I was going to do before the pandemic was that I was actually going to hire a drone operator, and all the investors who invested a minimum of $500,000 into this Class B to Class A office conversion, I was going to have a drone shot of them on top of the building for them to put in social media that they own this building, okay, after the close. Now, nobody knows the $100 million building. Nobody really knows if they own all of it, maybe 0.001% of it. But perception is everything, right? And that's really what it is that people are investing in things where they get the biggest boost. Because if you think about it, social media today is not just great for building brand awareness or personal brand awareness, but people are always competing with each other. It's really why I think like the high school reunion industry is going, way of the dodo bird, because everybody knows what's going on with everybody on Facebook, and it's the same stuff, and you can follow along. But to be able to post something like that enhances your status and gives you a shot in the arm, and it would cost me maybe $400 all in to have some guy do this for, from the local university. You come in and do this, right?
Right. And you're very active on social media. Sorry to interrupt. But what is your social media strategy?
My social media strategy is just to go out there and continue to impart content and continue to build a personal brand. That's really it. And to compel people to come over to talk to me. What I've noticed today, and it's interesting, it's on LinkedIn. I made a comment this morning with someone saying that he was sort of surprised by how many people have real estate businesses but no website, no LinkedIn presence. And I have to remind people, anyone who's raising capital out there, you need to make yourself known. You need to start building a personal brand. You need to start putting out content. We're very good at doing this. We have an opportunity where I've worked with a few people in our capital raising mastery program, where we've been able to show them how to do this with AI. But more or less, what you're doing is you're building a personal brand. Because whenever I go to a conference, they're going to ask me the website and my LinkedIn page. Okay, even if I'm paying $250 for it, to go to like some conference over in Miami Beach. I live in Miami. They're going to say, "Hey, okay, well, what's your LinkedIn? We want to approve you first." Because people now are just, you're coming up, and I talked about this in my book, Investing Legacy. You're dealing with cabals of influence right now. People want to make sure that, you follow the same value system that they do. It's a very polarized country, but people are going to be, scoping you out first before you start networking with the bigger investors. And so when you're working with investors, it's very important to me to make sure that I'm always on top of their mind, because when there is a time where I do need to call the capital, I've given so much value up front that I can probably just say, "Okay, I know you're not checking a lot of your emails, but here's what's going on. You need to, I want to be able to sort of corral everybody together when the time comes to be able to do this." And I also like to showcase the successes we have too, because if anyone later down the line is going to be searching me out, they're going to go down my LinkedIn timeline and say, what has Sal been posting? As to some that there's, very wealthy people, yes, are secretive, and there's some people today, but the investors who are on this mostly are dealing with investors who are retail investors, and they're going to want to be able to show their friends what they're investing into. If you can make it so that any investment that you're soliciting from your investors or LPs, that you're able to show immediately an elevation of status, that's going to be a big deal. I'll just tell you like a very simple thing. I just relaunched for the first time in a while because a lot of families have asked me to train their second gens on how the real estate business works. And I put together our certification program, acpar.org, ACPARE.org. I think you have to type in the www first as the prefix to that. But you'll see that there's 8 different courses there that we put together for people. And the reason is because they need to be able to learn how to transact with that. But afterwards, talk about the status. What they get is a thing on their on their LinkedIn that automatically says that they could, they completed the stabilized transaction mastery, value added transaction mastery, real estate capital structure mastery, things like that, so that they can showcase their skills, and it makes it easier for them to be credible in front of smaller investors when they don't know which way is up. Does that make sense?
Yes, it does. And I honestly haven't heard too many people talk about the status portion of, investing in something. And it does make sense to me now because real estate, it might be a boring asset class to some people. And if you can give them that status, it's huge. And then also what you said about social media, it's important because it's like the new business card. You show someone your website, especially your social media, your LinkedIn, sometimes Instagram and other social media platforms. It's huge. So
Yeah.
how do you actually get to meet these families first? Is it mostly through social media, or what's your main strategy?
No, I mean, yeah, it is mostly through social media, but the social media is more of like the verification. There are families out there who allocate and who are on social media, but they're not looking for deals per se on LinkedIn or especially Facebook because those are usually mediocre deals. But I am very, very active since living in Miami. There's all sorts of groups and that I've been accepted into. And it's mostly going through like lawyers and some service providers, but not all of them. And there's a lot, especially in Miami, there's like a gathering of, it's called Art Basel. We put on our family office investment conference around then too as well. One of the things though that's the most amazing part of it though is that just through, and I'll just tell you, like over the past 10 years, we've invested a lot into venture and life sciences and technology. And what I like to do is I like to meet the other investors and family offices in those deals. So if you have a good, if you're working with a CEO and a founder and he likes you, he's going to be like, well, you got to meet this family in New York. You got to meet this family. They're investors. They're investors. So now you're being introduced as a real qualified person who wrote a check. And these are the guys that have the trust and they'll come back to you saying, hey, I heard you're in real estate. Tell me about what it is. Okay, no first-time sponsors, audited financials, meaningful co-invest, right? And that's how the conversation starts. And you start building the relationship. I think, though, before I moved to Miami, I would come here for Art Basel. And I remember during the Bitcoin days, and everything was a hustle. And really, I think, I blame Gary Vee for this implicitly. But he really turned into like a hustle culture, much more transactional. And investors are looking for marriage. They're not looking for sex on the first date. Because whenever you're taking money from someone as a limited partner, you're signing an operating agreement, which is the equivalent of prenup when you think about it. And so a lot of people don't understand that the investors are looking at you, they're qualifying you, and that sign of haste and not building a relationship, you're not selling them a book, you're not selling them a car, you're not selling them anything where, they don't understand the investment. They don't believe you at first until you start building some sort of a relationship with them. And I do that on social media by speaking my voice.
Right. And you mentioned you started your first fund at 29, raised 30 million bucks. If you were to start over today raising capital, what would be the first steps you would take?
I would, that's a very good question. Everybody in this business does things ass ways, I feel as though. And that's probably because I've been trained differently professionally. I would start building investors first and start courting investors like followers, like an influencer, before finding a deal. If you're the money guy, the deals are always going to come to you. The last thing you want to do is find a deal. You don't really understand the deal that well, but you don't want to let someone down. Or you're trying to impress someone by trying to find an investor or close on something. I've seen this happen many, many times before, and it's very inefficient. Find the investors first. Okay, build a following of investors. Then at that point, and only then at that point, should you start looking for deals, but then you want to make sure that you're putting them into the best deals. Maybe they're not your deals, but maybe someone else who's a sponsor who's been through at least two cycles, right? Or a GP. That's how you start out getting into this business, is by raising capital for other people, because that's how you really understand the business, and you can actually understand and learn much faster what an investor wants and what they don't want.
Right. Yeah, and you covered earlier, you vet the sponsor, and that's kind of the main thing you look into. In terms of the deal, like what do you look for in terms of the deal you're investing in?
I mean, I mean, that's an open-ended question, right, Weston? I mean, you want something that's in line. You want a cap rate that's in line with the industry. You don't want to overpay for it. We like to go direct into the investment, so we don't work with broker dealers. They're like realtors of like private placements. If you don't like what's in their left shoulder, you're gonna love what's in their right pocket, right? So you got to be careful with that. But when we're looking at these deals, we want to make sure, as I said before, if there's other families that are investing into it, that's also very, very appropriate to us. We have one family in France that is investing in an industrial deal with us in Tampa, in the port of Tampa at some point when it comes online. Hopefully it does. That's great. That's a story that I get to tell people, and that's the story that they tell their spouses and friends and in-laws and outlaws.
Right. Yeah, and it seems like, you're doing all these kinds of different investments in business and real estate
Yeah.
now. Are you planning on still doing that moving forward, or what are your plans for the future?
Yeah, I'm still doing that. Yeah, I mean, I'm coming into my own right now seasonally, like a marsupial, because there's a lot of distress and there's things to get at a discount. We purposely walked away from the market in 2019, well, 2020 really, when things started getting really hectic with the pandemic, and interest rates were low and money was all over the place and people were bidding up multifamily, and that's usually the first sub asset class of the commercial asset class to get bid up. Is because there's a low barrier to entry to it. Anybody, it's an equal opportunity wealth creator. Anybody can get in if you can get a loan and cobble a few bucks together. People also overpay for it. So we purposely stuck out of there, or pulled out of that, and started focusing more on the technology and building the family office around that, but also keeping people at bay, holding them back, and building up the demand for them to invest in our real estate deals that we'll be showcasing later the fall.
Yeah, that makes sense, especially getting investors. I've seen just in the small amount of capital I've raised that a lot of people are coming to me now because it's hard to raise capital. They have deals, and you just have to pick the best one. And you get a lot of deals as a capital raiser.
There's a
So
lot of deals. There's more deals than there are grains of sand on Miami Beach.
yeah, yeah. And so let's talk about the real estate market. Obviously, we're in an election season. What are you
Mhm.
seeing in the market? The different asset classes. What are you really looking into?
Um, as I said, industrial, but I'll tell you what I don't like. I'm not a big fan of hotels right now. There's inflated wages in a lot of the blue cities, because of these people who are coming in are being subsidized by the local government. So that's putting an artificial bump on these hotel rates. Number two is you have a lot of unions, you have a lot of inflationary prices. And also, if you have fixed rate financing on these things and you can't raise your prices, because people aren't really traveling that much anymore, then, that's not good to be, it's not going to bode well for hotels. I know some people went into that after the pandemic, a lot of doctors and dentists did. But, when the consumer isn't traveling a lot, or, the businessman isn't traveling a lot, or there's just been a cut on travel globally because people can't afford it anymore. They max out their credit cards. Then that's not good for hotels. I think second, and if you look at the way the debt trades on hotel debt, it's not it's trading worse than office space right now. Office, I think, will come into its own at some point. I think culturally it's going to take some time to do it, but you need to be in a big city like New York. We did flirt with a deal around the Wall Street area with a very prominent family, but we couldn't get our head around the basis on that. But I think the bottom has come out for multifamily, and now it is going to be the time for people to get into multifamily. And the reason for that is because there hasn't really been a lot of stress. If you believe everybody that's talking on CNBC, they're saying that the banks are going to fail. You'll probably see one forced marriage, but that's about it. I don't think you're going to see too much. I think the worst is behind us, because a year from now, things are going to be different, and you don't want to foreclose. Foreclosing doesn't help anyone, neither the bank nor the sponsor, or the GP. So that is, some of the things that I think I'm bullish on right now. We're not players in multifamily, but we understand that multifamily, I think it's safer now to get into multifamily than it was in 2020. And if you can make a case of that to your LPs, saying we hit the bottom of the market, then you're going to be off to something. And I'll be writing some stuff on LinkedIn too about that.
Right. Yeah, and are there any specific real estate markets are you preferring right now to invest in?
We like Florida. We're in Nevada. We're probably going to be doing a big deal in Salt Lake City, in industrial.
Mhm.
I
Yeah,
mean, there's
just
four highways that cross near there. So, this is where this you got to follow the money, follow the good, follow the transportation routes.
yeah, just the larger markets that have the diversified job markets,
Yeah,
more safe. Seems like longer term holds is what your investors like.
yeah,
Yeah, and
yeah,
let's talk about opportunities in the business space. You said you're a VC investor.
yeah.
What kind of businesses are you really looking into right now?
Businesses that have high barriers to entry, right? So technology, AI, and life sciences too. We're doing life sciences and technology. We like them to have high barriers to entry. We don't like anything you see on Shark Tank, which is mostly consumer discretionaries. It could be knocked off by a kid in college or someone in China. That's just not something for us, right? We stay away from apps, but we like to make sure that we're working with pedigreed investors and pedigreed operators who've done this many, many times. We don't like, that's pretty much it. We don't like anything, if it's AI, I'd like to make sure that it's coming from Palo Alto, not somewhere like maybe like in, overseas or something like that. We only invest domestically. Our money is only happy in America. We're not going to be divesting into any companies or investing into any companies. We were getting close at one point with some overseas stuff, but we only have one overseas company we've invested into, and that's in the UK.
Hmm. And I've seen a lot of wealthy families like to invest in funds in the space because you're diversified across a lot of companies. Are you guys more direct in
We
you're
are
shaking your
direct
head?
investors. Yeah, we're principal investors. We put our money and the money that we raise from our families into these opportunities. So, we are a fund likes to take a shotgun approach, but a fund also has a different economic model where they're just trying to raise as much money as possible, spread it thin, hope something pops. And really, when you look at a lot of the Palo Alto firms today, they've really become more like monolithic utilities, right? I mean, they move very slow. If they do come onto your balance sheet or your capital structure, they're going to want full rights. They're going to want to take over everybody, squash your angel investors down. So the fund structure is great if you have $1 billion and you're very good at raising money, which we are, but we're also very careful and we're also very disciplined not to raise too much to be able to put it into these opportunities. That's not to say that we might not change our structure at some point in the real estate space should that merit it. However, right now, as it stands, our investors prefer to go direct because they feel as though they have discretion. A lot of these funds, they're too big. They're great for pensions. They're great for institutions. They're great for family offices with, probably over $1 billion in assets. But the guys over $100 million, if they're putting in a check for $500,000 or $1 million, they prefer to go direct.
Hmm. Yeah. So yeah, let's talk about how much. Hold on a sec. I'll edit this out.
Mhm.
Totally forgot my question.
That's right. I got 10 minutes left. Is that enough or?
10 minutes. That's plenty.
Yeah.
Yeah, we usually
Okay.
like to keep
Perfect.
these short and
Perfect.
compact. So
Okay.
let's go into who should contact you. Like we have a lot of families that watch this, operators. How could they partner with you, and what should they look for when they're reaching out?
If you are looking to impress your ex-girlfriend, call me, for the investments. We will enhance your status and you'll get to see what we're doing. We will onboard you to our multifamily office. Just send an email to sal at investinglegacy.com, sal at investinglegacy.com. And what I'll do is I'll onboard you to our multifamily office, and let me know, what you guys have invested into. And, maybe I'll give you a free copy of my book too if we speak on the phone. We do have other people who are starting out. They're looking to get started. For those people who are really looking to get started, we do have ACPAR up, and they can go to www.acpare.org. It's a certification. It's an organization. Or you can just email me, sal at investinglegacy.com. And that's the best way to get in contact.
Awesome. Sounds good. And you wrote 3 books, Sal, so we'll link those as
Yeah.
well below, and we'll
Yeah,
put your
thank you.
contact details there as well.
That is amazing. Weston, this is perfect. It's been great talking to you. I hope I got a good grade on this. I know you're calling or you're operating this from a college, so
Yeah, sounds good, Sal. Great having you on.
thank you. I appreciate you, my friend. Thank you.